All right. So it is 7 minutes, well, 6 minutes now. Just switched 6 minutes until we get started here. Looking forward to going through today's presentation for all of our audience, all of our investors that are interested in checking out this next opportunity with Molr Dental Club. Super excited to dive into the details here. So hang tight, guys. We're about to get started on today's Veterans Day. All right, all right. Welcome to today's webinar. Thank you for being here. Thank you for joining me. Let me know where you're joining me from in the comments. Let me know what state you're joining me from. This way I can let a few people in because I know we're going to have people joining late, and then we can dive into the content. We'll give people like a few minutes before we dive into today's presentation today. But thank you for joining us, especially today on Veterans Day. That's why I chose to wear this hat today. Hats off to all of our veterans that served. You know, we have what we have here in the United States because of the great sacrifices that men and women have given us. So let's never forget that. I am blessed to say that I come from a lot of different military personnel on both sides of the fence between my mom and my dad. So I've got a lot of people on my side that have served, and I am here today, and I have the opportunities I have today because of all of them. So that's how I want to start today's webinar. So I've got some people here from Michigan. Thank you for joining me. Thank you for commenting as well. If you haven't commented yet, open up the chat, open up the comments. Let me know what state you're joining me from as well. And then we will dive in to today's presentation here in a few minutes. California, awesome. Love California. Who doesn't? Who doesn't love California? All right. Where else? Where else are you joining me from? Let me know here in the comments. If you're just joining, because I just saw a spike in people joining. Before we dive into the presentation today, everybody needs to go in the comments. Let me know what state you're joining me from, and then we're going to dive into today's content. All right, all right, all right. So who's excited? Who's excited for today's content? Let me know in the chat. All right, guys. All right, well, we're going to dive in. We're probably going to get some people joining us because it always happens within the first 5 minutes, but that's fine. They should have been on time anyway, right? All right, so let me go ahead and let me share my screen. So let me know when you can see it, and then we will dive into today's content. All right, can you guys see my screen? Let me know in the chat. Let me just move something over here. This way I can see everything. All right, there we go. Perfect. Okay. All right, can you guys see my screen? Let me know. Give me a thumbs up if you can see my screen. Okay, can you see my screen? Give me a thumbs up. Give me a thumbs up. Okay, good. I got a yes. Okay, we're in business. Awesome. Okay, cool. All right, guys. So today's presentation is about getting passive income in a 600,000 per year leading oral care brand with a targeted 6x ROI by July 1st of next year. Now, this is a private investor webinar, and during this webinar, we will reveal how anyone can use the same private equity investing strategies that the ultra wealthy use to build wealth. This exclusive opportunity allows accredited and non-accredited investors to own equity in a fast-growing dental care brand that's already serving 350,000 families across North America. Today, you're going to discover how you can participate in the same private equity strategies that have built generational wealth for the ultra wealthy. So, quick investment disclaimer before we dive into today's content. Important notice here. So my company, ARM5 Formula Company, is conducting this capital raise under regulation crowdfunding, which is otherwise known as Reg CF, which allows eligible investors to participate in early stage private equity opportunities, or private company opportunities is what I meant to say. Investments in private companies are speculative and involve risk. Past performance is not indicative of future results. There's no guarantee of liquidity, profit, or return on your investment. You should carefully review all offering materials and disclosures before making any investment decision, and consult with a licensed financial advisor if needed. So basically, invest at your own caution. Okay, let me dive in and introduce myself. If you don't know me already, my name is Josh Marsden. I'm a U.S. Army veteran. I served from 2001 to 2005. I'm also an MBA graduate. I'm also an international best-selling author in e-commerce. I published 2 books. One of them was number 1 in 11 different countries back in July of 2020. I've also had over 18 e-com business acquisitions now since 2022. Since 2013, I've helped thousands of e-com companies through online events, coaching, and also client services. I've had about 100 million in online sales through my various works since 2013. And I've been seen or heard on Forbes and also local media outlets like Superfast Business, Big Commerce, and also various other media outlets as well. And my story in a nutshell is simply this. So back in early 2013, I had a opportunity to make a decision to dive into building a business. And I just had started at a B2B sales company selling IT products and services. And right away, they gave me an ultimatum. They said that I would have to change my schedule with my then 3-year-old son. He's 16 now. So it's quite some time ago now. But they told me that I would have to work 7 a.m. to 7 p.m. Monday through Friday. Work hard, play hard was our culture. And if you can't stay until 7 p.m. Monday through Friday, then this is not a good fit for you, and we're going to have to let you go. And they gave me the ultimatum. They said, hey, I want you to go into this weekend. It was the 3rd weekend that I was there. And they said I had to make a decision that weekend if I was going to change my schedule with my son in order to stay at that company. And so that weekend, I just weighed the 2 options I had. Dive into building my business. And I had a few freelance clients, not enough to cover my bills, but I had a little bit of a start. And then the other option was stay at that company where I could make 6+ figures. And after looking at both, there was no way I was going to stay at that company, because to me, it meant more to me to be the best dad that I could be and to build this business and build a life around what's important to me. And so that's what I did back in early 2013. I took that leap of faith and I built a marketing agency that became a fairly well-known marketing agency, fairly successful marketing agency for the first 9 years, 2013 until the end of 2021. And then in 2022, we made a pivot in our business, and we decided to stop selling services and to focus our energy and our time on buying e-com businesses, building up e-com businesses. This way we could build up to a 9+ figure valuation, which has now become a $1 billion market cap goal by 2029. So it's evolved over the last few years since we went in this direction. And over the last few years, because of the pivot, because of the hard work that's happened at my company, we've made the Inc. 5000 now 2 years in a row, 2024 and 2025. And now we're working on taking our company public in 2026. This way we can return a lot of value and a lot of impact to all of our investors. Okay, so I already went over our milestones and our evolution. So I'm just going to skip this just so I don't waste anybody's time. Now, as I mentioned before, things have kind of evolved over the last few years. You know, when I first started in this direction in 2022, my goal was just to build a portfolio of e-com companies and to roll them up and package them and sell them, because I know that roll-ups get bigger multiples, bigger exits, and they create more wealth than selling individual businesses. And I wanted to do back in 2022, $200 to $300 million plus exits. That was the goal then. But then over the last few years, it just evolved, it changed. And I also went through different challenges and learned a lot of different things along the way, as you do in entrepreneurship. And I figured out that for us to really be able to accomplish our goals of buying big, really good, low risk companies that we can then scale up and turn into more value for us and our investors, the best way for us to do that is not to stay private. It's not to lean on banks and processes that take forever to get through. It's to go public. It's to access public capital. And so that shifted our vision over the last 12 months. So now our vision is to become a $1 billion company by 2029. And right now we're working towards the upcoming milestones, which is to get to 10 million in top line revenue by January 31st. And also after that, we want to then keep acquiring companies, about 1 to 2 companies every quarter, doing between 2 million to 10 million EBITDA, which, if you're not familiar with that term, basically is very similar to net profit per year. And then we'll get to 100 million in annual revenue. The goal is to get there by the end of next year. And then from that point on, just continue to grow, continue to scale, and get to that $1 billion market cap by 2029. And currently, here are some milestones in our pre-NASDAQ drive. So number one, back in January this year, we signed an agreement with Direct IPO to take my company public. So now we're working with them to get our company listed, and we're driving towards the NASDAQ. That's our goal. We also want to complete key acquisitions. We've got 2 companies. One of them we're about to close, and that's InfraReady. And now we have Molr Dental Club, which we'll talk about a lot today. And we'll also have a third company that's still to be determined that we also will acquire over the next few months. So this way we can get to 10 million in top line revenue by January 31st, 2026. And also on top of that, we're not just focusing on buying and growing e-com businesses. We're also creating something that we believe is going to be revolutionary, that's going to help us stand out in the e-commerce crowd. And also it's going to create a lot of value, a lot of impact for our shareholders, for our investors. And a lot of deep research went into this decision. And so we have come up with a blueprint already, a very detailed blueprint with our tech partners at xngen.ai. Hats off to Jeff McPherson over there. And we have now a blueprint to develop ARM5 Formula AI, which is a series of agentic AI applications specifically for e-commerce businesses. And this is going to be powerful for us and our companies. It's going to be powerful for other e-com businesses that use it, because other people can use this software after we launch it. It's basically going to increase performance and reduce cost, which is always a win-win, because as an owner, those are always your 2 goals. Your 2 goals are to increase revenue and decrease costs. This will do both. So it's going to be very impactful for our companies. And it's also going to be very impactful for all e-com companies that come onto the platform and use it after we launch it in early 2026. And as I mentioned before, our goal is to get to the NASDAQ. We have basically a roadmap right now that we're executing on. This way we can accomplish this by July 1st next year. That's our goal. So that's our pre-NASDAQ drive. And now I'm going to dive into something that I've learned over the last several years, being around some very successful, wealthy people. They're also good people, a good majority of them. And I've learned a lot along the way. And I'm trying to share my knowledge with people out there that can get value from this knowledge. Because I believe that as a citizen of this earth, as a human being, that's what we should be doing. Is we should always be striving to provide value, providing impact, and then that value will come back to you. So this is how we're going to kick things off today. Why the ultra wealthy keep private equity quiet. So here's what they teach you. Okay, they teach you get a good job. They tell you save 10 to 15%, maybe even more of your income. I know there's a lot of financial experts that tell you to save a lot more than that even. Max out your 401k, invest in stocks and your own home. Hope for 7% annual returns. Retire at 65, maybe. That doesn't really happen that often, actually, unfortunately. And what they actually do is they invest long-term in top stocks and index funds. They buy real estate, not as their own home necessarily, but as cash flowing assets. That's really what they focus on. They also become their own banks by leveraging life insurance policies. This way they can loan against their life insurance policy and make moves and build more wealth from their life insurance policies. They invest in private, passive income generating companies before they scale. They target 20 to 40% or more even annual returns. And they create generational wealth with this approach, and they retire whenever they choose. So the wealthy understand a fundamental truth. True wealth comes from owning pieces of valuable businesses, not from trading time for money. They invest in private equity opportunities, exactly like this one that I'm about to reveal to you, before companies go public and capture the most significant appreciation. Now, the myth of traditional retirement investing. So, for decades, we've been told that stocks and real estate are the safe or best vehicles for retirement and long-term wealth building. And while the S&P 500 has averaged around 7% per year long-term, there's growing evidence that this performance may not continue. Rising inflation, unprecedented monetary policy, and major macroeconomic shifts suggest that future returns may fall well short of past decades. And so the private equity advantage is this: the numbers don't lie. Private equity has consistently outperformed public markets, delivering superior returns to investors who can access these opportunities. For example, private equity returns since 2000 have been on average 11% per year. Public market returns have been on average 7.2%. So the 4% difference there. And then the private equity growth multiple has been about 19.9x. That's the total portfolio growth since 2000. And then also the public growth multiple has been 6.6x. So as you can see, it's a pretty significant difference when it comes to private versus public market growth. Now, according to MSCI Private Capital Solutions, private equity investments deliver an average premium of approximately 4.86% annually over public market alternatives. This premium compounds significantly over time. As you know, when every gain you make, it adds more opportunities because of the fact that you're stacking your wins over time. So consider this, for example, 100,000 invested in private equity in 2000 would have grown to approximately 1.99 million compared to just 660,000 in public markets. That shows you the difference. There's a difference here of 1.33 million, or more than triple the return, simply by accessing the private markets that the ultra wealthy have been using for decades. But luckily, we live in a world today here in 2025 where information is coming downstream, and these opportunities are now being unlocked for everybody. And here's why the mega rich prefer private ownership. So the Warren Buffett approach here. So Warren Buffett has this quote. He says, "Be fearful when others are greedy, and greedy when others are fearful." And it's basically zig when other people are zagging. Don't just go with the wave of people and do the same thing everybody else is doing. Go against what the average person is doing. And that's definitely a way to be, in my opinion, when it comes to making moves and investing. You should never just not do something just because other people are not doing it. You should consider it, not saying you should do it, but you should definitely consider it and assess it, in my opinion. So Buffett's advantage comes from permanent capital, allowing him to practice counter-cyclical investing, buying valuable assets during market downturns when others are forced to sell. See, around 40% of family offices now include private equity as a core asset in their investment strategies, following the ultra-wealthy playbook. And these sophisticated investors understand that private ownership offers control and influence, direct input into business strategy and operations, superior returns, access to high growth opportunities before public markets, portfolio diversification, uncorrelated returns that reduce overall risk, tax advantages, preferential treatment for long-term capital gains, and reduced volatility, no daily mark-to-market fluctuations. And here's how major investment vehicles are currently performing this year. This way you can kind of see the land, so to speak. You can see where capital is working harder, because this is key if you're going to get your hard-earned capital to work harder for you. This way you can hit your goal within the time frame that you're trying to reach it by. So for example, saving CDs, they're at about 4 to 5% when it comes to ROI, very low risk level, high liquidity. But right now, the outlook here in 2025 is savings and CDs are declining. They're safe, but they're losing right now to inflation, which is about 3%. Money market, 4 to 5% typical ROI as well, low risk, high liquidity, stable, but cash is parking, minimal growth. And then you have bonds. Bonds are about 3 to 6%. There's a low to moderate risk level. You have medium liquidity options. The outlook is uncertain at this point, and also this is sensitive to interest rates. Then you have real estate. Real estate is about 6 to 10% moderate risk level, low liquidity. Your money's basically stuck until you sell the home, or if you're renting it out, obviously you see some residual from that. The outlook is slowing currently, and there's a high capital requirement, but it's also a illiquid investment. You can't, if you see a big opportunity coming and your money's all tied up in real estate, well, I mean, unless you desperately sell your real estate, which is probably not going to happen, you're going to miss out on a big opportunity. For example, the stock market. So with the stock market, it's about 7 to 10% when it comes to a typical ROI. There's a moderate risk level here, high liquidity. You could sell your stock, using apps like Robinhood, Fidelity, etc. There's a mixed outlook right now. There's some volatility. There's high valuations. We're right now in, a big hype around AI in the stock markets. So there's definitely some, concerns right now with the stock market. And then you have cryptocurrency, which the ROI can vary, but the risk level is very, very high. Liquidity is high. It's just like stocks. You could sell it right away. The outlook is speculative at this point. But again, there's extreme volatility and there's regulatory risk. And then there's private equity. And what I recommend is e-commerce. You've got 20 to 40% or more typical ROI, moderate risk level, low, medium liquidity. You also have an expanding current and future outlook. There's high growth potential, and you have direct equity ownership. So the clear winner here, really, as you can see, based on the stats, based on the data, is private equity and e-commerce investments offer the highest potential returns while maintaining moderate risk through established business models and cash flow. This is where sophisticated investors are allocating capital right now in 2025, and this is actually where the ultra wealthy has been allocating capital for the last 100 plus years. You just didn't know because you didn't think it was possible, but it is possible. Okay, so here's the recommended sweet spot. When you listen to billionaires like Tony Robbins or Ray Dalio, or even some up and comers, they're always saying you need to put about 5 to 15% into private businesses out of your investment portfolio. And the reason why is because it enhances your overall portfolio performance without excessive concentration risk. Now, for one, you have better returns when you do this. Private equity's 11% average annual return significantly outpaces traditional investments, compounding wealth faster over time. You could also spread out the risk. Private investments are uncorrelated with stock market fluctuations, providing true diversification when public markets decline. You also have more control. Direct ownership gives you visibility into operations and strategy, unlike public stocks where you're completely passive. You're a passive shareholder and you don't really have any type of input or impact to the business whatsoever. And then you have cash flow potential as well. See, many private investments generate regular distributions from operating profits, passive income, while your equity in the company appreciates, while the value of the company scales and grows. And so, for example, the company we're going to dive into today, Molr Dental Club, is an opportunity that's perfectly positioned for this allocation strategy. It offers immediate cash flow through profit sharing, equity appreciation potential through the ARM5 platform, and a clear exit path via the planned NASDAQ listing that I've just gone over with you. And e-commerce, it's not going anywhere, okay, guys? It's still growing. It's projected to be a $7.9 trillion industry by 2027. So, while many predicted e-commerce growth would slow after the pandemic era acceleration, because in the pandemic era, we saw buying behavior shift by 5 times what they were expecting going into 2020, because COVID kept everybody at home. People were buying more online than ever before. And that's why, buying behaviors shifted dramatically, and e-commerce is still growing. That just gave it a big steroid injection, basically. And now, we're seeing e-commerce just continue to grow. And online retail continues expanding at a remarkable pace, driven by improved logistics, mobile shopping adoption worldwide, and changing consumer preferences. And e-commerce offers distinct advantages over traditional retail. For one, always on operations. They can generate revenue 24/7, 365 days a year. Global reach. They can serve customers anywhere. Lower overhead, no expensive storefronts, better data. We can track every customer interaction. We literally know what everybody does every step of the way along the buying journey, every step of the way, which is awesome. Faster scaling. You can add SKUs without physical constraints because we don't have to worry about necessarily keeping a bunch of inventory in a warehouse. We can test and offer before we do that. For example, higher margins. We can reduce the middleman cost. Personalization. We can tailor experiences to individuals, especially today with AI and AI's impact on e-commerce as well. And then automation. Technology handles repetitive tasks. E-commerce is superior to a brick and mortar business. That's why whenever I talk to someone about buying a business, I always steer them towards e-commerce or maybe even, maybe SaaS, but e-commerce definitely is my number one recommendation. And here are some comparisons, e-commerce investing comparisons. So, while traditional investments have their place, I'm not discounting them completely. I'm just telling you that you definitely want to have some of your portfolio in private equity, and I recommend e-commerce being that piece. And as you can see here, this compares the potential of various business investment types. You have brick and mortar businesses. The typical yearly ROI is about 8 to 12%. The control is moderate. The liquidity is low. Your money's typically just stuck. Risk level is high. And you have location, you've got leases, you've got overhead machinery, you've got overhead costs that are superior versus e-commerce because, let's just say it's a US based business. You're paying US based pricing on people. You're paying minimum wage. You're paying salaries. It's not cheap. You're also limited by geography with a brick and mortar. And it's also sometimes, not always, but usually slow and seasonal. And then you've got real estate. Real estate, the typical yearly ROI is about 7 to 10%. You've got low control, moderate liquidity, moderate risk level, market dependent. Obviously, there's government factors that play a role in how well the real estate industry is doing, as we have felt over the last few years. It is somewhat predictable over the long term, but it is also capped. And you have franchises. Franchises have a typical yearly ROI of 12 to 18%. You have low control, low liquidity, moderate risk level, limited autonomy, and that's when it comes to scalability. And then also when it comes to cash flow potential, it's consistent, but fees cut profits because you're always paying the parent company out of your profits, which, sucks because you work hard for your revenues and your profits. You want to keep those profits as much as possible. With e-commerce, the typical yearly ROI, as I mentioned before, is 20 to 40% or more. You have high control. It's a high liquidity investment because it's a digital asset. You also have lower overhead versus these other business types. Scalability wise, global, you have infinite scalability, and then cash flow potential is reoccurring and compounding over time because e-commerce is very, very scalable. So e-commerce combines the agility of digital technology with the profitability of global reach. You can scale from local to worldwide without additional real estate or staff, automate nearly every process with AI, and build a sellable digital asset that compounds in value. So smart money isn't just looking for cash flow, it's looking for scalable, tech-enabled businesses that multiply returns. And I highly recommend that you are just like that statement, because right now AI is growing like a wildfire. It's impacting every business type. And e-commerce, in my opinion, is one of the best businesses that take advantage of the current AI wave. Okay, let's talk about the oral care market. It's a rapidly growing market. The global oral care market represents a massive recession-resistant opportunity driven by fundamental human needs and increasing health awareness. As you can see here in this graph, 2024, it was worth $37 billion. Okay. And over the next several years, it's going to be growing to a $54 billion industry by 2030. And that represents a compound annual growth rate of 6.2%. And North America holds the largest market share at 31.4%, with strong consumer spending power and high oral health awareness. So there's about 3.5 billion people worldwide that suffer from oral disease, creating massive demand for prevention and treatment solutions. And 20% US adults have untreated dental caries, representing a significant untapped market for at-home care. And then, as I mentioned before, we've got a 6.2% compound annual growth rate through 2030, which outpaces general economic growth. And here's why consumers are spending differently on oral health. Consumer behavior around oral health is shifting dramatically. People are investing more in preventive dental health, viewing it as essential to overall wellness rather than discretionary spending. As a matter of fact, spending is just shifting altogether towards staying younger, longevity, because we're all recognizing the time we're in, that we're going to live much longer lives. So we're investing more so into our health and into longevity, and dental care falls in line with that. So here are a few areas where consumers are spending. For one, preventive wellness priority. Consumers increasingly prioritize preventive dental care and at-home solutions over expensive, reactive professional treatments. LED whitening kits, electric toothbrushes, and daily care systems let people maintain oral health proactively and also affordably, especially versus going into a dentist. And then enhanced living and confidence. Interest in biohacking, recovery, and longevity, as I mentioned, extends naturally to oral health. People recognize that a healthy white smile boosts confidence in professional and personal settings. Oral care has become part of self-optimization and aesthetic enhancement. And then value shift in spending. So research shows approximately 77% of consumers now prioritize well-being spending over traditional material goods. Rather than buying another gadget or an outfit, people invest in health, appearance, and wellness products that deliver lasting value. Okay, so now let's enter into modern oral care and at-home dental solutions. So at-home dental devices are revolutionizing how consumers approach oral health. Professional quality results are now accessible without expensive dental office visits. You can see some of the products that are out there right now in the wild on the right, for example. And so Molr's complete product line consists of the following. The current bestsellers for Molr Dental Club are LED whitening kits, which is their top selling product, which delivers professional whitening results at home using safe blue light technology. We also have the V34 Purple Teeth Cleaner, which is an innovative color correcting serum that neutralizes yellow tones instantly. We also have charcoal powders and gels, natural whitening solutions using activated charcoal to remove surface stains. And upcoming launches include an electric toothbrush, which is a multi-mode sonic cleaning with smart timer and pressure sensor toothbrush, and a water flosser, which is a portable device for deep cleaning between teeth and along the gum line, and subscription refills where you can have auto delivery of brush heads, whitening gel, and consumables, kind of similar to like the Dollar Beard Club, for example, and getting like a fresh razor consistently. People are subscribing to services like that to maintain their look. And this is just an example of what Molr is going to be doing in the very near future with RM5. And then here's how electric toothbrushes and whitening kits help your smile. I mean, most of you can probably figure this out, but we're going to dive into this a little bit. So the science is clear. Modern oral care devices deliver measurably superior results compared to traditional manual methods. And electric toothbrush clinical evidence, for example, a comprehensive 2022 clinical study demonstrated the remarkable effectiveness of powered toothbrushes. Participants using electric toothbrushes experienced dramatic improvements. For example, during this study, they saw plaque reduction at 2 weeks. Plaque scores dropped from 60.2 to 44, a significant improvement in just 14 days. And plaque reduction at 6 weeks also was significant as well. It went from 43.8, I'm running up a little bit, to 20.5, with more than half the plaque eliminated. Okay, so this stuff works, and that's why people are buying this stuff. This is why this is a growing category and a great category for you as an investor to be a part of. Okay, so in summary, so here are some of the key benefits for consumers. Electric toothbrushes, significantly more efficient plaque removal, improved gum health, and reduced gingivitis. Less manual effort required. Built-in timers encourage proper brushing duration. Multiple cleaning modes also for sensitive teeth. And you also have LED whitening kits. You can remove years of staining from coffee, wine, or tobacco. It's also safe blue violet light, which accelerates the whitening gel effects. You have noticeable whiter teeth in 1 to 2 weeks. Typically, it's a fraction of the cost versus professional treatments going down to a dental office and getting their full-on, teeth whitening procedure. It's much cheaper than that, and it boosts confidence and your professional appearance. And here is the electric toothbrush market opportunity, just to highlight this for a moment. So as you can see, electric toothbrushes represent one of the fastest growing segments in oral care, with consumers increasingly recognizing their superior effectiveness. So in 2025, as you can see here, it's on track to be a $3.6 billion market. But then by 2034, all projections point to it becoming an even more valuable market with 5.36 billion at that point. So it's going to be a very, very, very lucrative market for everybody involved over the next several years. And then, as I mentioned before, you have a growing rate of 4.5%, as you saw in this graph here, which is very substantial. That shows sustained growth in a proven product category. North America is the hot spot for this. It holds over 36% market share with high consumer adoption rates and premium product preference. But Asia Pacific is accelerating right now as a market. It's the fastest growing region right now with about 10% average growth rate, driven by rising middle class and also health awareness. So Molr's upcoming products, and specifically the electric toothbrush launch, positions them perfectly to capture market share in this expanding category, leveraging our existing customer base and distribution channels. And then here is the market opportunity by application. So Molr Dental Club has a multi-channel strategy here to capture revenue across 4 high margin segments, each with distinct growth drivers and customer profiles. So for one, I've mentioned this quite a bit, the at-home teeth whitening category. So there's a growing popularity among beauty and wellness conscious customers seeking professional results without dental office costs. LED whitening kits offer high margins, 60 to 70%, and strong repeat purchase patterns. This segment appeals to millennials and Generation Z, prioritizing aesthetics and self-care. You also have dental offices and professional offices. This is an exceptional business model. Dental practices purchasing Molr products maintain an 80% retention rate and average $3,000 in annual spending. So this is a great channel to continue to focus on for Molr Dental Club. You also have wholesale and retail channels. There's already partnerships with TJ Maxx and Marshalls already established in this company that we're about to dive into. There's also advanced discussions right now with Walmart, Costco, Sephora, and Brookshire Brothers as well, which is a 200-store grocery chain. And bulk orders from wholesale and retailers provide significant revenue spikes while building mainstream brand awareness at scale. And then you also have the opportunity for family subscription bundles. This is an opportunity to reintroduce subscription models with electric toothbrush head refills, whitening gel replacements, and family care kits for the entire family. So this is an opportunity that can dramatically increase customer lifetime value while ensuring consistent monthly revenue and reducing acquisition costs as well. So what is Molr Dental Club? So Molr is an online oral care brand founded in 2016. So it's been around for about 9 years now, with a mission to make professional quality dental care accessible and affordable for everyone. And we've built a loyal customer base and established profitable distribution channels across multiple market segments. So here is some facts about Molr Dental Club. There's been about 350,000 families served across US and Canada since launch. There's a 33% repeat customer rate right now, which is a very high repeat customer rate. If you're above 25% in e-commerce, that's pretty damn good. We also have an 80% dental office retention. Practices reorder year after year. And there's a 3,000 average annual spend per dental office customer. So when they get a dental office customer, that customer keeps coming back, which is an awesome account to have. And here's what sets Molr Dental apart. So there's exceptional margins in this company. The direct to consumer profit margin is about 50 to 70%, and the wholesale margin is about 60 to 65%, and retail is about 30 to 38%. It's 100% organic traffic at this point. There's currently zero paid advertising. So this is massive upside when marketing launches under our management. And there's already strong wholesale partnerships with TJ Maxx and Marshalls. They already put in bulk orders consistently because of agreements that Molr Dental Club has with those retailers. And they're in advanced discussions, as I mentioned before, with Walmart and Costco, and very close to closing some of those deals as well. And I'm sure that we will over the next several months under our management. And then we have a product pipeline. As I mentioned before, we have electric toothbrushes and water flossers launching very, very soon. And then on top of that too, they have a high level of compliance and quality. They have an FDA approved factory. Medical device is certified in Canada with all taxes filed. Okay, so here is the financial snapshot and average monthly profit, just to give you an idea. So as you can see by this graph, it's a very, very profitable company. COGS is very, very low compared to its revenue. And so to break that down further, the gross margin of this company is about 84%, which is among the highest in e-com. If you're doing above 60% gross margin, that's pretty good. Like we've got a company in-house, for example, that's at an 89% gross margin. 84% is almost there. So that's really, really, really good. Its monthly profit is about $25,000 on average. And that's according to the last 12 months. So it's a recent average. There's zero debt level. There's zero debt that we're inheriting when we buy Molr Dental Club, which means all profits after seller financing payments go to the owners and investors. And there's going to be only a small group of investors that are going to benefit from this. And when you look at the results, and if you jump into a meeting with us, we'll go through all the prior financial performance, all future projections as well, and answer any questions you have. But you'll see that, for example, in July, there was a $200,000 profit from a large wholesale order, and September delivered $89,000, which demonstrates the business's ability to scale dramatically with retail partnerships. And current advertising spend is minimal. This is a huge channel that can unlock a lot of revenue and a lot of profits. They have not focused on direct-to-consumer marketing and direct-to-consumer advertising, and that's our specialty. So it's super exciting for everybody that comes on to this company and works with us on this company. Super exciting for everybody involved. So just to go ahead and kind of summarize this slide, here's the investor advantage here. With such high margins and low operating costs, Molr can afford generous profit distributions to investors while simultaneously reinvesting in growth. This dual benefit, immediate cash flow plus equity appreciation, is rare in early stage investments. Okay, so here are just some growth drivers that we're going to apply to this company. So Molr's current success represents just the foundation. With strategic investments across 5 key areas, we project explosive revenue growth while maintaining profitability. So for one, as I've mentioned before, digital marketing expansion. There's 0 paid ads currently. We're going to invest in performance marketing, Google, Facebook, TikTok, Amazon, even to scale direct-to-consumer revenue. The current 0.51% conversion rate also is pretty low. The average Shopify store, e-commerce store, is usually about 1 to 3%. So this is definitely lower than that. So we have a huge opportunity to bump that up, get it up to 2 to 3, maybe even higher. The highest we've ever done is about 8% consistently, which we could possibly do with this brand as well, which will dramatically increase sales from existing and future traffic. And then we have the product line expansion. As I mentioned before, we can launch the electric toothbrush and water flosser, which we're planning on doing before the end of the year. We can introduce a subscription refill program for brush heads and whitening gel, which will add subscription revenue and predictable revenue and consistency, which is great. And we can explore eco-friendly packaging to appeal to sustainability conscious consumers as well. And each new SKU increases average order value. And then we have the wholesale and retail expansion. So the big reason why we were attracted to this is because they've done a great job with wholesale, with retail. And we're going to be inheriting a lot of those relationships that we can apply towards all of our companies, which is going to be phenomenal for all of our companies and all of our investors. But this company already has good retail relationships with TJ Maxx, with Marshalls, as I mentioned before, and they're further down the line with discussions with Costco and Walmart as well. So we're very close to closing some big deals there too, and that's only going to add to the business as we're driving direct to consumer marketing and direct to consumer advertising. So it's definitely some very exciting stuff here on the wholesale and retail expansion side. And then we have cross selling and bundling. We can offer wellness bundles, which combines Molr oral care with other RM5 products. We have sleep aids, we have recovery devices, we have all sorts of stuff that are just really good fits in some very special bundle offers that nobody else can offer, which is super exciting. It's going to add a lot of revenue profits to this business. So it's very complementary. And then on top of that too, we have operational efficiency. We can maintain lean, zero employee model while also scaling with 3PL fulfillment. We can implement AEO or GEO, that's answer engine optimization. If you didn't know, is basically the new search engine optimization, but leveraging AI. And we'll be able to get an early mover's advantage on that because we have the processes in-house to be able to apply to this business to get it to rank for AI searches. This way we can start to see business coming in from AI searches. And right now, that is where to go as a marketer to get early movers advantage, because right now other businesses are scrambling, trying to catch up and trying to rank for AI search to keep their business relevant. Because if they're not doing it, then other businesses are going to come in and take that market share because traffic is disappearing from Google and going to ChatGPT and Perplexity and all those other AI softwares out there. Okay. And then finally, just some other things here. So we're also going to continue to cross-sell and really leverage our portfolio. We're also going to dive into an ambassador and influencer program. This is a great business to have a significant in-depth ambassador and influencer program, very easy product to get people to promote. And as I mentioned before, we're going to implement our processes to stay on top of the current trends with AI search and AEO and or GEO is another way to talk about that specifically. And as I mentioned, it's a good strategic fit within the RM5 portfolio because we only focus on beauty and health brands. So it just fits in very, very well and adds a lot of value to Molr Dental Club too. So this way we could turn this into a bigger winner than it already is for the investors that are a part of this company. And here are just some of the advantages by Molr Dental Club joining our portfolio. We have shared logistics. We have 3PL facilities that we can consolidate our fulfillment within the RM5 brands, and Molr Dental Club can be a part of that. We also can combine customer lists and cross-market because these are people that care about how they look, their longevity, so they care about oral health. We also have an AI marketing platform. We have a trademarked marketing and scaling methodology we've been using over the last 13 years that has strategies and processes that are highly documented, detailed, that we can apply towards this business. And we're also working on, as I mentioned before, launching our agentic AI software that's going to be super impactful for Molr Dental Club as well. And then we also have our subscription bundles where we can launch cross-brand subscription packages. And we're unique in that we're one of the only companies that can do that because we have multiple brands, we have multiple product lines. And so we can create offers like that are unique and sexy and irresistible that attract people where other brands can't do the same thing. So consider the ideal customer profile: health conscious professionals aged 30 to 50 who prioritize wellness, appearance, and performance. This demographic invests in quality sleep, recovery from workouts or stress, and maintaining a confident, healthy smile. By offering integrated solutions, RM5 becomes the trusted brand for comprehensive wellness, not just individual products. Okay, so this is how we're going to be able to achieve a 6x plus ROI or more for investors by July 1st. So unlike most early stage investments that lock up capital for years, that's not what this is. See, Molr provides immediate returns through monthly profit distributions, literally immediately starting later this month. So right after we close and we acquire this company, And with current net profit averaging 25,000 per month, and as I mentioned before, over 80% gross margins, your capital begins working for you from day one. So here's the steps to liquidity: invest, earn, convert, grow, and then liquidity. And here's exactly how investors in Molr can turn a $50,000 stake, as an example, into potentially 300,000, maybe even more in value by December 31st next year through monthly profit share and early stage equity conversion into ARM5 Formula Company and participation in our public listing strategy. So, for example, a $50,000 investment receiving 15.5% of net profits is projected to earn about $5,874.60 per month at current and future projected levels. And that's according to projections based on prior performance. And we're happy to, again, go over this in detail with you in a meeting so you can see how we came to those numbers. And then as marketing scales revenue, this passive income increases proportionally, all while your equity appreciates towards the exit event. Okay, so step one, as I mentioned, is immediate monthly cash flow. So I've captured here in this image November this month to March next year. And that's around the time that we estimate that we're going to convert investors in Molr Dental Club into shareholders of ARM5 Formula Company. But we're doing it at a favorable 13 million pre-money valuation. So today's pre-money valuation instead of next year's valuation, which I estimate is going to be somewhere in between 20 million to 30 million at that point in time when we convert investors into shareholders of ARM5. Okay. So new investors join Molr right now with a minimum $25,000 allocation, becoming a key part of our growth trajectory. And then there'll be monthly profit share right away. Investors can receive up to 30% of Molr's net profits monthly based on the level of their investment, directly reflecting the company's real operational performance. And then there's a predictable yield. Monthly deposits are projected to continue through approximately, as I mentioned, February to March 2026. That's the target timeframe when we'll convert you into shares. And between now and then, you'll just earn profit share out of this company. And so, as I mentioned before, a $50,000 investment generating 15% monthly profit share could yield approximately $5,874 each month, totaling around $29,000 over this 5-month period. Okay, and then step two, as I mentioned, which we're targeting around March for this to happen, will then convert you into ARM5 shares ahead of us going public. And the reason why we have to do that is because when you go public, you have to clear an audit. The SEC has to audit your entire business, and you have to streamline your investors and your cap table. And all your investors need to be a part of the parent company to keep things simple and clean. And so we'll convert you at that point in time. This way you can participate in the upcoming listing. So that's why I see that around March is when this will happen. But as you can see here, this opportunity gives you a significant ROI opportunity as soon as next year. And that's how we're able to get you a target 6x plus ROI by July 1st next year, is because when we hit our target goal of going public by July 1st, you'll have, let's just say it's a $50,000 investment, you'll have about 42,306 shares. And that's based on the 13 million pre-money conversion and the 10 million shares available. Just so you know where we came up with that. And so that means that that $50,000 investment, now this is good, better, best. According to our research, we should be getting somewhere between 8x to 20x of our revenue. But there are variables. Obviously, this is all based on research. This is based on other e-commerce aggregators that have gone public like us. This is based on us folding in our agentic AI software, which is very valuable in the public markets. And so we could get a 20x, or we may end up with an 8x. Either way, there's still some very substantial opportunity here for us and for new investors. So basically, your $50,000 investment, you'll earn profit share from now until we convert you into shares of ARM5. And then when we list and get on the NASDAQ, you'll have shares of our company, but you'll have shares at a 13 million pre-money conversion instead of tomorrow's valuation and conversion to that valuation, which means that your shares, say July 1st next year, should be worth somewhere in between 106,000 to 265,000 for a $50,000 investment. Now, you won't be able to liquidate right then and there. Let's just say it's July 1st and we go on the NASDAQ on July 1st. You won't be able to sell your shares right then and there. There's going to be a 6-month lockout period. But then after the 6 months, you can apply to sell some of your shares. And, I'm not quite sure how that process is going to look, but my intention is to engineer it in a way where investors can get back their original investment and keep their profit right. So you should be able by the end of next year to get back your original investment and then keep your profit riding. And we're going to be scaling this thing over the next few years. And as I mentioned before, our goal is to get to $1 billion market cap by 2029. When we hit that goal, your shares could be worth a heck of a lot more, and you won't want to sell them early. Okay. All right. So let me just go through these steps here. Number one, strategic conversion point. As I mentioned before, in March, approximately 2026, all investors for Molr Dental Club will convert their full investment and bonuses into ARM5 Formula Company stock. Number two, you're at a pre-public valuation lock of 13 million, not next year's projected 20 to 30 or more million market cap. Number three, foundational share price. So investors are effectively receiving shares at about $1.30 each before the public uplisting. And then number four, significant upside potential. Those same shares could be worth $8 to $12, maybe even more, maybe $20 or more at our $80 to $120 million plus valuation target for July 1st of next year. Okay, step three, public listing and liquidity and long-term growth. I already kind of went over this. I talked ahead a little bit, but I'll just recap this real quickly. So as I mentioned before, we're targeting a NASDAQ listing by July 1st. We're aiming for an 80 to 120 million or more valuation, which will mark the company's official entry into the public markets. And then there'll be a 6-month lockout period post-listing. And then after that, investors gain the flexibility to liquidate a portion of their shares. And our goal is to help you realize your initial investment back. And this way you can keep your profit riding. And then after that, you can keep your shares or you can sell your shares. It's up to you, because it's going to be like shares that you have in any company at that point. So you could sell them or you could keep them. But if we continue to grow, and we hit our $1 billion market cap goal by 2029, you're going to hope that you kept your shares because they're going to be worth a lot of money at that point. And as I mentioned before, this is a research-backed valuation model. And here's why our targets are grounded. And we actually have a whole doc of research that we give to potential investors that reach out that want to invest in one of our companies. And so we're happy to share that with you too. This way you can do your due diligence. But this kind of just summarizes the research that went into this, because this is not hype. This is literally modeled from real software and AI market multiples. So this is what we had realistic expectations that we can communicate with you, and also just have realistic expectations for ourselves as well. So for example, this is key market benchmarks based on 2025 data. Public software companies typically got around 6x of the revenue. Private software M&A is about 4.8. Top quartile got 8 to 10x. And then AI companies fetch somewhere in between 15 to 24x revenue multiples due to high growth and data moats. So as I mentioned before, that's why our range is somewhere in between 8 to 20x of our revenue. That's why we have a few different investment pictures here, because we're basing our projection based on the data, and we could end up with an 8x, we could end up with a 12x, we could end up with a 20x. And so that's what all the research points to. And this is an incredible opportunity, obviously, for you and for us, and we'd love to have you on board. So I invite you to join us in transforming oral health. This opportunity combines everything sophisticated investors seek: profitability, untapped growth potential, market tailwinds, and a clear exit strategy. So for one, this is a company that's profitable and cash flowing. It's already doing $300,000 net profit over the last 12 months with strong gross margins of 84%. There's immediate monthly distributions that literally begin after closing, which is literally in the next week. So therefore, later this month, you'll have your first profit share distribution. So from day one, you're earning back cash flow for your investment. And then there's untapped growth potential. This company is currently running zero paid advertising. That alone is enough to scale this company, but there's multiple other opportunities, but that is a big, big, big opportunity. And digital marketing investment will unlock exponential sales growth while maintaining high margins. So there's low hanging fruit everywhere in this company. It's a large growing market, as I've highlighted today. $37.8 billion oral care market growing to $54.1 billion by 2030. There's 3.5 billion people worldwide that suffer from oral diseases. The electric toothbrush segment is expanding rapidly right now, and market tailwinds will propel growth. And then we have a product innovation pipeline. We have new electric toothbrushes and water flossers launching soon, high margin consumables with brush heads, whitening gel, which creates recurring revenue opportunities. So we can create a sticky brand that continues to perpetually produce revenue profits every time we acquire a customer, which is ideal for any investor in any business. And then we have portfolio synergy. The ARM5 platform provides marketing technology, shared logistics, cross-selling opportunities, and operational expertise as well. And we have a combined customer base of 350,000 families already ready for the bundled offerings that we can offer to the customers of Molr Dental Club. And then, as I mentioned, we have a clear exit strategy. We have a NASDAQ listing planned for mid-2026, which creates a liquidity event, could be a very powerful liquidity event due to our strategy that's combining agentic AI with e-com to, very potent market categories that can create a lot of value in the public markets and for shareholders like you. So bottom line is timing matters. You're investing at the inflection point after product market fit is proven, before massive scaling begins. And this is precisely when the ultra wealthy deploy capital for maximum returns. So here's the investment opportunity. Here are some terms and some bonuses. So in every single investment agreement, we have a 2x ROI guarantee, which means that your investment is guaranteed to double in 36 months, or your capital is returned. So we have 3 years to accomplish that. With everything you see here, won't be an issue. And then the investment bonus here. So we actually have an investment bonus right now available to get you moving, which will help us close this. And this way we can give you profit share right away this month. And so for investments up to $99,000, we're giving a 10% investment bonus. So for example, if you invest 50, you'll actually get credited 55,000, for example. And then for investments at 100,000 or more, which there's only one spot because there's only an allocation of 150,000 here. So we can only offer this literally to one investor. But we are giving an investor, if they choose to invest 100,000 or more to fill the entire $150,000 allocation, we'll give them a 20% bonus on their money. So if they invest 100,000, they're getting credited 120,000. And that's to profit share in Molr Dental Club and also into shares as well into ARM5. So you get a lot of ROI opportunities with that bonus. Okay. So if you're interested in reserving an allocation, being a part of this and what we're building, which I believe is very special here at ARM5 Formula Company, then scan this QR code right away or go to arm5formula.com/call to schedule your consultation. You'll actually connect with me directly. There's about maybe 4 to 5 spots max to fill up this allocation. It's a first come, first serve. This way we don't take a biased approach. Whoever signs the agreement first wins. And then after that, you'll then wire the investment into a special account that's untouched, that's used specifically for the acquisition and growth of Molr Dental Club. So I recommend that you take action right away, take advantage of this exciting opportunity. It will come, it will go. We just had another one that just came and went. And that was a great one. This is another great one, so don't miss out on it. But for now, I'm going to go ahead and stop talking, get some water. Plus, I have a little bit of a head cold. I don't know if you can tell from my voice, but I'm going to take a second here to get some water, and I'm going to address any questions that you guys have as well. So let me know here in the comments what questions that you have for me. All right, guys, don't be shy. What questions do you have? Let me know in the comments here, and I'll go through them one by one. All right, right. Last chance for questions. Going once, going twice. All right, all right. Well, thank you so much. If you're joining me here live, if you're catching the replay, thank you for spending some time in the replay. You made a smart decision to dedicate some time towards your future. Act now. This is a great opportunity. I'd love to see you book a call, meet with me. We can discuss it, go through all the details, and then welcome you into this opportunity, which I believe is going to turn a lucky 4 to 5 people's hard-earned capital into a lot more over the next 12, 24, 36 months. So thank you for letting me serve you today, and I look forward to seeing you guys next week. Okay, question came in. Barry, thank you for the question. Will we get the replay? Yes, you will have access to replay for 72 hours. So yes, you will get access to the replay. All right. Any other questions, Barry, before I close out here? All right. Okay. Cool. Any other questions? Yep. No problem. You got it. All right. I think that's a wrap. All right. Again, thank you for letting me serve you today, and take action right away, guys. And I'll see you guys on the next webinar.